Hello, students. This is chapter one, dealing with the 10 principles of economics. And in this chapter, the key questions that we seek answers to are as follows. What kinds of questions does economics address? What are the principles of how people make decisions? What are the principles of how people interact? What are the principles of how the economy as a whole works? So we're going to take them one by one, but economics is all about using scarce resources to produce the goods and services that society enjoys. So we know that resources are scarce, and scarcity is defined as the limited nature of society's resources. That means society has limited resources or scarce resources. We cannot produce all the goods and services people wish to have. And so, in that respect, economics is defined as the study of how society manages its scarce resources. Economists study how people decide what to buy, how much to work, save, and spend, how farms decide how much to produce, how many workers to hire, how society decides how to divide its resources between national defense, consumer goods, protecting the environment, and other needs. Of these 10 principles, the first four principles deal with how people make decisions. Principle number one, people face trade offs. Principle number two, the cost of something is what you give up to get it. Principle number three, rational people think at the margin. Principle number four, people respond to incentives. Let's take these one by one. Principle number one, people face trade offs. And that means to get something that we like, we have to give up something else that we also like. That's a fact of life. For example, going to a party the night before an exam, bad idea. That means there's less time to study. That's a trade off. Having more money to buy stuff, that means you have to work long hours. What is the trade off? There's less time for leisure. You don't have time for yourself. Protecting the environment means resources could be used to produce consumer goods. So we have to make do with less consumer goods if we have to have a clean environment. Society also faces trade offs. The more it spends on national defense to protect its shores, the less it can spend on consumer goods to raise the standard of living of our citizens. The trade-off is between guns, national defense, and butter. If we produce more guns, that means less butter. Produce more butter, that means less guns. Trade-off. Pollution regulations means cleaner environment and improved health, but the trade-off, the cost of reducing the incomes of farms and farm owners, workers, and customers. Society also faces trade-off between efficiency and equality. Efficiency, that means society gets the most from its scarce resources. That means the most efficient use of society's resources. But equality means prosperity is distributed uniformly among society's members. What is the trade-off? To achieve greater equality, we, we could redistribute income from wealthier members of society to poor members of society. But this reduces incentives to work and produce, and therefore shrinks the size of the economic pie. Therefore, there's a trade off. If we go for more efficiency, we're going to reduce equality. If we emphasize on equality as a goal, efficiency will suffer. Trade off. Let's look at principle number two. The cost of something is what you give up to get it. People make decisions and they have to compare costs with benefits of alternatives. Okay, so you need to have or you need to include opportunity cost in your decision making. Opportunity cost is defined as whatever must be given up to obtain the item, the foregone alternatives. That is the opportunity cost. The opportunity cost of going to college for a year, that means you have to incur tuition, books, and fees, plus foregone wages. Going to the movies, the price of the movie ticket is a cost, plus the value of the time you spend in the theater. Every decision involves opportunity cost. Principle number three, rational people think at the margin. Rationality means people systematically and purposefully do the best they can to achieve their objectives. That is rational thinking. Given the available opportunities, make decisions by evaluating costs and benefits of marginal changes. Marginal means small, incremental adjustments to a plan of action. People think at the margin. For example, cell phone users with unlimited minutes, that means the minutes are free at the margin. Often people make long, frivolous calls because as long as the marginal benefits is greater than zero, there's going to be long talk. A manager considers whether to increase output. He compares the cost of the needed labor and materials to the extra revenue. Marginal benefits compared to marginal costs. Principle number four, people respond to incentives. Incentives is something that induces a person to act. For example, when gas prices rise, consumers buy more hybrid cars and fewer gasoline SUVs. When cigarette taxes increase, teen smoking falls. Principle number four, people respond to incentive. We change our behavior in response to incentives. Let's look at an example, an active learning example to apply these principles. You are selling your 2007 Mustang. You have already spent $1,000 to repair it. At the last minute, the transmission dies. You can pay $900 to have it repaired or sell the car as is. What would be involved in your decision making? In each of the following scenarios, should you have the transmission repaired? Now, let's look at number A scenario. Blue book value, that is what you could get for the car, is 7,500 if transmission works. But you can only get 6,200 if transmission doesn't work. Scenario number B, the blue book value is 6,300 if transmission works, $5,500 if it doesn't work. So let's look at the decision point here. The cost of fixing a car of fixing the transmission is $900. The blue book value is 7,500. If transmission works, $6,200 if it doesn't. So the benefit of fixing the car is 1,300. That is 7,500 minus 6,200. The cost of fixing the car is 900. Since the cost is less than the benefit, you should go ahead and fix the transmission. Marginal benefit exceeds marginal cost. The second scenario, the blue book value is $6,300 if transmission works, 5,500 if it doesn't. Benefit of fixing the transmission, therefore, is 6,300 minus 5,500, and that's 800. Since the benefit of fixing the transmission is 800, and that is less than the cost of fixing the transmission, which is 900, you should sell this car as it is. Decision making. The next set three principles deal with how people interact in society. Principle number 5, trade can make everyone better off. Principle number 6, markets are usually a good way to organize economic activity. Principle number 7, governments can sometimes improve market outcomes. Let's look at them one by one. Trade can make everyone better off. Principle number 5. People benefit from trade. People can buy a greater variety of goods and services at lower cost than if you produced everything you need by yourself. Countries also benefit from trade and specialization. Okay, we get better prices abroad for goods that are produced overseas. And we buy other goods more cheaply from abroad than could be produced locally. Trade is good for you and I. Trade is also good for countries. Principle number 6, markets are usually a good way to organize economic activity. A market is an institutional arrangement that brings buyers and sellers together, and it need not be a location as long as there is a network of communication that brings buyers and sellers together. A market has existed. And so a market is a group of buyers and sellers. So economic activity is organized within the confines of a market. The meaning of this is there are three basic questions that must be answered within the marketplace. What goods and services to produce? How much of each to produce? Who produced and consumed these goods? Those questions are answered in the marketplace. The market economy allocates resources. It is the decentralized decisions of many firms and households as they interact in markets. Famous insight by Adam Smith in his book, The Wealth of Nations, published in 1776. Each of these households and farms, as they interact in the marketplace, act as if led by an invisible hand to promote the general economic well being. That means people and farms interact in the marketplace, pursuing their self interest. But like an invisible hand, society is better off. Prices are determined in the marketplace. Okay? Prices are determined by the interaction of buyers and sellers. Prices reflect the goods value to buyers. Prices reflect the cost of producing the goods to the sellers. The invisible hand here is the price. Price guide self-interested households and farms to make decisions that maximize society's economic well-being. Principle number 7, governments can sometimes improve market outcomes. Government enforce property rights, that is, enforce rules and maintain institutions that are key to a market economy. People are less inclined to work, produce, invest, or purchase if large risk of their property being stolen exists. So the government provides a level playing ground with the rule of law. Governments promote efficiency. Avoid market failures. Markets left on its own fails to allocate scarce resources efficiently. In other words, markets fail if there is no government to promote efficiency. Externality is a source of market failure. Externality, whether negative or positive, is the production or consumption of a good. If the production or consumption of a good affects a bystander, whether it is pollution or something positive like education, externality has existed. When externality exists, the market has failed. And the government's role is to correct for externality. Another source of market power, another source of market failure, beg your pardon, is market power. Markets function when there is competition, buyers and sellers competing with one another. If there is market power, the markets fail. Market power is a single buyer or a single seller has substantial influence on market price, and we call that monopoly. Anytime monopoly exists in the marketplace, efficiency declines and market fails. And the role of government comes in here to correct for market power and encourage competition, and also to correct for externality to ensure that markets function properly. Governments also promote equality. You do not want to live in a society where there are 10 millionaires and 10 million beggars. So the government promotes equality, avoiding these kinds of disparities in economic well being. So the government uses tax or welfare policies to change how the economic pie is sliced. That is promoting equality. Active learning, too, this is a discussion question. Think about this. In each of the following situations, what is the government's role? Does the government's intervention improve the outcome? Number A, public schools. Number B, workplace safety regulations. Number C, public highways. Number D, patent laws, which allow drug companies to charge high prices for life saving drugs. How do you assess the role of government in this? The last three principles deal with how the economy as a whole works. So, principle number 8, a country's standard of living depends on its ability to produce goods and services. Principle number 9, prices rise when government prints too much money. We call that inflation. Principle number 10, society faces a short term trade off between inflation and unemployment. Let's take it one by one. Principle number 8, a country's standard of living depends on its ability to produce goods and services. There is a huge variation in living standards. Here in the United States, some people have got a lot. They're millionaires and they're billionaires, and they're poor people. There is also variation across countries and over time. Average income in rich countries is more than 10 times average income in poor countries. The United States standard of living today is about 8 times larger than 100 years ago. Principle number 8, country's standard of living depends on its ability to produce goods and services. And producing goods and services depends on productivity. How do we define productivity? The most important determinant of living standards. Principle number 8, a country's standard of living depends on its ability to produce goods and services. And producing those goods and services is determined by productivity. The most important determinant of living standards is productivity. Productivity is defined as the quantity of goods and services produced from each unit of labor input. Productivity depends on the availability of equipment, skills of the workers, and technology available. Other factors, minor, include labor unions, competition from abroad, but these have far less impact on living standards. Most important determinant of living standard is productivity. Principle number 9, prices rise when the government prints too much money. And that's inflation. Inflation is defined as an increase in the overall level of prices in the economy. In the long run, inflation is almost always caused by excessive growth in the quantity of money, which causes the value of money to fall. There is an inverse relationship between the value of money and the quantity of money. Too much money, the value of money goes down. Too little money, the value of money goes up. The faster the government creates money, the greater the inflation rate. Principle number 10, society faces a short run trade off between inflation and unemployment. Short run trade off between unemployment and inflation. Over a period of a year or two, many economic policies push inflation and unemployment in opposite directions. The good old trade off. Even though we would like low unemployment and low inflation, in the short run, it is not possible to achieve both. If you lower the unemployment, you will see inflation increasing. If you try to lower inflation, unemployment will rise. Other factors can make this trade off more or less favorable, but the trade off is always present. Summary. The fundamental lessons about individual decision making, that's the first four principles. Number one, people face trade off among alternative goals. Number two, the cost of any action is measured in terms of foregone opportunities. Number three, rational people make decisions by comparing marginal costs and marginal benefits. Number four, people change their behavior in response to the incentives they face. The next three principles deal with how people interact, the fundamental lessons about interactions among people. Trade and interdependence can be mutually beneficial. Number five. Number six, markets are usually a good way of coordinating economic activity among people. Number seven, the government can potentially improve market outcomes by remedying market failure or by promoting greater economic equality. The last set of principles, fundamental lessons about the economy. Number eight, productivity is the ultimate source of living standards. Number nine, growth in the quantity of money is the ultimate source of inflation. Number 10, society faces a short run trade off between inflation and unemployment. That is the end, ladies and gentlemen, and we are on to chapter 2.